Hi, I'm Niël Pretorius. I'm the Chief Executive of DRDGOLD. Our company is situated in Johannesburg, South Africa. We're listed both here and on the New York Stock Exchange with a market cap of just over $2 billion. We produce gold from mine tailings, and we are set up to produce between 100 and 155,000 ounces of gold per annum.
Yeah, good to see you. Exciting times for gold producers for sure. You guys are producing cash. And I mentioned today, and so talking about what do you do with it? How do you behave? How do you take advantage of a situation like this? So, firstly, talk to your stock. Obviously, people it's reacting well. Shareholders are happy at the moment.
Yes, well, depending on when you bought your shares, if you bought them 2 weeks ago, then you're looking at about a 15 to 20% loss on your investment. But if you've been in the stock for a while now, then you could be well up from where you were last year. So it remains steeply geared to movements in the gold price. We mention that. We do say to people, this is a stock for professionals. But please get some professional advice before you buy, because we don't hedge, and it does respond sharply to movements in the gold price. Those of us that have been in the stock a very long time, though, it's a good time for us, even after the recent decline.
Okay, so gold price has actually come off a bit, maybe, and also maybe some people taking profits off the table, as they should. All good stuff. Let's focus on stuff that you can control. We've talked in the past about the efficiencies of engineering, etc. But I want to focus on, I guess, this capital accumulation and how you treat that. So things like growth capital, growth capex. For you guys, how do you intend to kind of finance things going forward whilst maintaining debt-free balance sheets?
When you're in mining, and depending on what your strategy is and what your value proposition is, our strategy and value proposition is to optimize our existing resource base and then to ultimately leverage off, hopefully, some sort of strategic advantage that we establish in terms of infrastructure. So our focus is to optimize that ore body, which means that you have to build the infrastructure that you require in order to process for as long as you can at the requisite throughput rates, because we mine tailings. And it's low-grade material. The only way that you do that sustainably is if your throughput rate is high enough. That means very large capital infrastructure. Now, we've now, in the recent past, taken a decision that we were not going to close the old Ergo circuit. That was our first major tailings project, which we started just after 2008. It had a 12-year life of mine plan at the time, and the infrastructure investment that was made at the time was focused on mining the ore body that supported the capital both at the time. But as the gold price environment changed, and as we realized, but hang on a second, there's just too much value left. We can't just close this thing down. We decided that we want to extend the life of mine, and that means more deposition space and more pipeline routes and more reclamation areas, etc., as we close down the areas that form the core of that initial production profile. And that we hope will take us to past 2040. So there's a lot of capex going into that. It started off with the construction of a solar farm, but a lot of capex around that. And then also with regards to our second asset, Far West Gold Recoveries. There too, we started with a relatively modest throughput rate of 500,000 tons a month. Its deposition facility will start coming under pressure next year. So there we're building a very large new tailings facility, probably one of the largest lined tailings facilities in South Africa, if not the world. An 800-hectare facility that will ultimately have capacity to take more than 800 million tons of mine residue, mine waste material. Now, all of this takes a lot of capex, and what we're doing is, because we've committed to this, and we committed to this at a much lower gold price, and also before we saw this rally in the gold price, we want to do this while this cycle lasts. And notwithstanding the fact that the gold price has now come off, what was it, $4,300 not too long ago, it's back to just under $4,000 an ounce. It's still a very attractive gold price. If you had offered this to us 3 years ago, without hesitation, we would have said, yes, please, can we have that for a while? And this is putting us in a position where we can actually fund these capital expansion projects and these future positioning projects, we call it Vision 2028, without having to dip into a facility that we established. Because we were going to go into peak capital 2026, And at the assumed gold price at the time when we designed this project, this initiative, we would have had to take on a bit of debt during this period, but we still cash flow positive. We're still generating free cash flow, notwithstanding the fact that we're maintaining the investment rate that's required to meet our targets.
Okay, so it's not exactly free money, but it's money you perhaps hadn't expected to have on your balance sheet. So in terms of what does that look like in terms of percentage of free cash flow being allocated to growth capital and sustaining capital, given the kind of obviously milking the Ergo project?
Yes, certainly. Typically our sustaining capex is about 5% of cash operating costs. Now it's a lot higher. We're spending between $100 and $120 million per year. We have done so for the last 2 years, and we'll continue doing both this year and next year. And so all of this is in place. So all of that's going to come off, because remember, we're also long capex. So you put up the infrastructure, you build the pipelines, you build the tailings dam, you do the additions to your plant, and then you pretty much set up, and then you go back to that around about 5% of cash operating costs going forward on a per ounce basis. So it's bound to look considerably different, but at the moment it's still very high. And the advantage, of course, of the much higher gold price than the one that we used when we designed the project, and based upon which we motivated the reinvestment, that gold price has enabled us to also continue paying a dividend. In fact, the dividend that we paid now at the end of the financial year was double that of the previous dividend that we declared at the same time. So it has been a much higher gold price than what we had anticipated.
But if I again go back to conversations we've had about the engineering and the percentage points that you guys chase, clearly with the new tailings storage facility coming online, you will continue to optimize, ore blending and circuit optimization and all of those kind of good things. But are there any aspects of any of the kind of trade-off studies that you're looking at where you kind of feel we can relax a little bit here? Because I think that we've got more money than we thought, and maybe we can get focused on a sort of longer-term solution rather than the here and now.
Matt, we don't gauge our efficiency on the basis of dollar per ounce. We gauge our efficiency on the basis of rand per ton. How much it's costing us to process every ton, and that hasn't changed. And I think as long as the current executive leadership is in place, I'm talking about both myself, my colleague CFO, our Chief Operating Officer, our head of production, and our head of technical services, as long as those individuals are around, I think that'll be our philosophy. That will be our primary efficiency measure, and we continue to look at it like that. And you cannot do it any other way, in my opinion, when you're in the business of processing tailings, because remember, as we go into this new era at both circuits, not so much at Far West Gold, but at Ergo in particular, your head grades reduce. So your revenue per ton will reduce on a flat gold price. So the gold price could help it over time, but if the gold price stayed flat, then your revenue per ton reduces. And that being or is lower than what it was a year ago, 2 years ago, when your head grades were higher. And the only way that you could sustainably mine that and motivate the capital that you're investing in order to access that and to optimize that is by reducing your rand per ton costs, your unit costs on a per ton basis. A big catalyst for Ergo was the construction of the solar farm, which has taken care of about half of Ergo's power requirements. On a sunny day, 12 hours, half of its power that it requires with the solar farm in combination with the power storage facility we have, the BESS facility, is taken care of. So you're looking at a very significant reduction in your power consumption, which means a 9 to 15 rand, depending on which time of day it is, reduction on your rand per ton costs. So that means, and you basically take that forward in your entire construct. But that's how you stay ahead of the game. So yes, it's nice to make all of these profits, but it's not changing the way that we look at efficiency, and it's certainly not changing the way at which we look at whether or not we successfully mining this ore body. The ideology has stayed the same.
Okay, so but as you kind of, there will be a sort of transition out of Ergo at some point, the Ergo infrastructure, etc., at some point, and you understand the way that you measure things, but in sort of in ways that I can understand. In terms of the return on capital or invested capital across evolving across new capital projects. I mean, how what does that transition look like in terms of time and that transfer of capital allocation?
Well, both of these operations we're now setting up to go beyond 2040. And obviously everything, or most of the things that we want to do in order to get there, to set it up, to maintain those throughput rates to beyond that point, that will by and large be done by the end of 2028, early 2029. We can still take early occupation on some of the infrastructure and so forth. Now, you can't just sit there and not do anything. I mean, what's the point then? You've got to start doing other things too. The infrastructure that we're building does give us a strategic advantage where we could play some sort of a consolidation role in the areas where we exist, where we're operating. But then at the same time also, we do believe that our model essentially still is an environmental restoration model. Because what you want to do is take mine waste where it is, process it, and place it somewhere else where it should be. And that way open up some, and the opportunity, I believe, for us lies in the open pit space. So you have some very large projects that are reaching maturity across the world. And these are the people that we're reaching out to now. And this is what we want to do beyond 2028 and start those conversations now to the extent that they're willing to listen to us. But we believe that with the standards that are required from mines, and these are oftentimes self-imposed standards with regards to environmental restoration, re-establishment of ecosystems, biodiversity, etc., selling your mature assets definitely is no longer an option. You've got to close them. And closing them merely to a rehabilitation standard is also becoming increasingly inadequate. What we're seeing more and more corporates wanting to do is actually restore nature and restore ecosystems. And we believe that if we could be a role player and if we could assist and partner with other companies to take their tailings, reprocess it at scale, and redeposit it into the pits that they had created, then the evidence that there used to be a mine is very significantly reduced to the point where it could almost be neutral. Now, you're never going to restore it 100%, but you're going to go a long way. And I think more and more corporates, more and more executives, and more boards are thinking like that. You know, the typical cycle for a mine, and in certain areas it still is the case, the typical cycle for a mine is you find the resource, you develop the mine, you mine it within 5 years of closure, and then you sell it. Then it becomes non-core, and you sell it to somebody else. And rehabilitation, closure, etc., that's no longer your problem. You contain it responsibly. You contain the impacts that your operation has on the environment. You contain that responsibly. But then the final closure, the breaking down of the plant, the salvaging of material, the vegetation of tailings, the permanent storage facilities, and so forth, that becomes somebody else's problem. The problem is the people that invariably, or in many instances, the people that it gets sold to, if you make a mistake there, then sometimes they hardly have enough capital to invest in optimizing the last 5 years, let alone bring about the responsible closure of that mine. And increasingly the rules become far more transparent. There are activist groups and lawyers, for that matter, who are scrutinizing these things. And I think also being more aware of what's going on at your operations, we're finding that the self-imposed standard amongst corporates has changed also to the extent that they're saying, but that's not who we are. That's not who we want to be. That's not how we want to be remembered. So they want to achieve a higher standard of environmental closure. But it wasn't part of the initial modeling. So how do you do that without hurting your balance sheet? And how do you do that without dipping into other cash flows in order to cover this? Because in most instances also, the cover that you have for rehabilitation closure, that's locked in a trust fund or in some sort of an instrument that you can only access once the work's done. So you're going to have to spend the cash. There's a cash flow implication. I think what my technical colleagues have figured out is how you can unlock and optimize the latent revenue generating potential of mine waste and apply that towards mine closure. And even if it doesn't run at a full profit, it can still make a very substantial and significant contribution if it's part subsidized by what you were going to spend on rehabilitation in any event. That's our story. That's our vision. That's the solution that we want to take to other corporates. And what I think we will be able to then deliver ultimately is that picture, that photograph, that story picture over time where you could say to your stakeholders, your broader stakeholder base, this is what it used to look like, and this is what it looks like now. And to my shareholders, we didn't dilute your returns. We actually did this by simply just applying something that was there, and that never formed part of our value proposition. You never bought our share because you wanted us to go and reprocess tailings. You bought our share because we're in primary mining, we've got good ore bodies. But we took what we threw away, and we used that to bring about this outcome. And that's what people want. That's what responsible investors want nowadays.
Well, you talk about sustainably gold on the front cover of your PowerPoint. So I think what you just said is worthy in the entire conversation in its own right. And maybe we'll come back to that one. But let me just pick up on the slightly earlier stage as you're kind of feeding into that process in terms of how you challenge the various teams in terms of these ESG linked metrics, things like energy intensity per ton or water reuse rates. I mean, how do you challenge them with those sorts of ESG linked metrics?
Unfortunately, ESG was sort of brought on as an add-on to business, and companies like to win. CEOs like to win, so they want to have the best ESG credentials. And I think what they quickly realized was that if you were to say to your shareholders, listen, I'm not paying you a dividend this year, but by the way, we have some really hot stuff that we did on the ESG front, they're going to take their money elsewhere. Yeah. So unless it's embedded, unless it's become integrated in your business, you're not going to succeed. You'll get all sorts of accolades, but you're not going to succeed as a business, or you will no longer be the sort of the one that people go to. I think where we sort of lost the plot, we knew that something had to change, but we sort of lost the plot when we moved away from the principles that the pioneers of sustainable, the Poles and those guys, when they described how you bring sustainability goals into your business model, how it becomes part of your integrated supply chain for that matter. And obviously they were looking at it from a retail perspective, the retail and manufacturing perspective. If it doesn't provide some sort of overlapping integrated value, if what you do with the environment doesn't contribute to your financial bottom line, or at least reduce operational risk, if what you do to society does not contribute, even if it's only in the sense of having a more stable social environment within which you operate, then what you're doing is just pay a tax. And it's just that it's a different kind of tax. And then you're going to get caught out. So it's not a race, it's not a parade, it's not a competition. It's something that forms part of good business management. And the way to describe it is, if your sustainability is not sustainable, then it's not sustainable development. Then it's just sustainability. Sustainability's got to be sustainable. So giving the tautology, but I think we sort of lost that along the way, especially in the way that ESG was implemented and rolled out.
Well, I think so. I think it was a box ticking exercise for most funds without necessarily believing it. And it's nice to sort of see a kind of robustness. Well, yeah, as you've described, and integral to the business operations, but beyond is critical. But ultimately, people want to look at the, as you write, bottom line. Are you making money? And to that end, can you just sort of remind us in terms of the kind of critical path risks that you have and risk mitigation you have for kind of Q1, say 2027 financial year, when it comes to DP2, to the tailings storage facility and the Daggerfontein, all happening simultaneously, right?
Yeah, absolutely. Look, DP2 that's the plant that's going along nicely.
Yeah.
I think it's probably the largest engineering project in the mining industry in South Africa at the moment. It's a formidable. Yeah, we talk about 300,000 tons a month as a modest throughput. Here we're building an additional 600,000 month capacity. We're adding a very large smelt house to that with state-of-the-art security. It's a thing of beauty if you're an engineer. Even if you're not an engineer, you have to be impressed. It's like walking into, even if you're not spiritual, the Canterbury Cathedral impresses you. There's a spirituality about it. So even if you're not an engineer, you walk into this plant and you think, wow, this is good. So that's going along nicely. The RTSF is going well, except that we have weather to contend with. So execution risk there in terms of meeting timelines are associated mostly with weather, because it's a very large area that's going to be flattened and then covered in plastic. We can take early occupation before the dam's finished, though. So our early occupation or early commissioning date has not been moved on. We haven't adapted that. We do have contingencies, 3 to 4 month contingencies that are built in our program schedule. But if anything is going to get in the way there, then it'll be weather. We're going into the rainy season now. It's our second rainy season, so obviously we're hoping that this time around will be, that will be better than last time. We fell behind by about 40 days during the previous rainy season, but it was a rain of biblical proportions. I mean, it started in December and didn't finish until May. So it was a disproportionately wet year. In terms of pipeline routes and so forth, there typically it's, just turnaround on licensing and so forth. We started earlier, and I think we've also learned from previous experience, but that's really the only place where we foresee a bit of an issue there. Not for lack of engagement. In terms of Ergo, at Ergo we've got to build a tailings facility that is similar in terms of what it does with regards to the environment, but it's a different area. So there's going to be a construction. Construction is going to be complicated or complex, and the licensing and design there is also complex. So we're working hard towards meeting out. We're hoping to start construction there during the latter half of next year. That's the one that will expand Ergo's own capacity, deposition capacity. That's the Withok Dam. So we're hoping to start construction by then. If we don't manage to get that, if we have to change that, then we're going to have to look at a contingency, and we are looking at a contingency plan. So there's a regulatory complexity at Withok, there is a construction complexity, and as a consequence, we're also working on a contingency there. But it's and I choose to believe that it's a remote contingency, but you've got to have these nonetheless. And then in terms of Daggafontein, that's going along nicely. It's a matter of getting the pipelines in place, and that process is going along quite nicely. There are one or two areas where landowners are taking advantage of our little piece of land has suddenly become very, very important, very valuable. But those are also just being dealt with commercially, and also engaging some of the local councils in that regard. But we're hoping to have that up and running soon as well, because something that's become important to us with the Brakpan facility, which is the one that's been used for Ergo now, well, it's been around since 1984, and it's been Ergo's main deposition facility. There we've already reduced our deposition rate from 2.1 million tons a month to 1.6 million tons a month. It's a very large dam. It's an old dam, and we want to start systematically reducing our deposition rate onto that dam until it gets to very, very low levels, like at 250, 300,000 ton a month. And Dagga will be the first step towards that. Once Daggafontein is up and running, we could take a substantial portion of the amount of deposition that goes onto the Brakpan facility. We can start taking that off. And that's an important target for us, because we do want to go into the decommissioning phase for that now over the next 3 to 4 years of that dam.
Okay, interesting. With regards to, I guess with DP2, have you kind of designed, is there a modularity to this? Do you envisage it, expanding beyond its kind of current capacity?
DP2,
capacity, I should say?
The DP2 will stay at 1.2 million tons. So what we're doing now is really just adding a second module. It is a plant which, although it's running at 500,000 tons a month, has a 300,000 ton a month throughput. So there is this is the second module to double its size. If we want to increase throughput at our west to match the capacity of the tailings dam, which is 2.4 million tons per month, will be 2.4 million tons from about 2030 onwards. You will systematically increase that deposition rate. Near term, we want to do 1.2 million tons a month. If I say near term, then it means from once Vision 28 has been fully put into effect, so it's maybe medium term, maybe a better description. It's going to be 1.2 million tons, and that's the infrastructure. That's the size of the infrastructure that we're building now. It's 1.2 million tons per month. But that dam will, as and when it's fully done, when it's fully constructed, will be able to take 2.4 million tons a month. If we want to go from 1.2 to 2.4 or anywhere towards that, it'll mean new infrastructure. It'll probably be another plant.
Right.
And remember, we're part of a larger group. We're part of Sibanye-Stillwater. They own several plants in that area. They don't, over the next few years, some of those plants will become available. And it might be another case of simply just upgrading an existing plant. So that typically would be the way that you would want to increase that.
Okay, and with regards to, again, this constant chasing of efficiency gain, I think you've talked about consolidating elution, smelting capacity with DP2. Is that in this phase?
Yes, that is. But it's unsmelted, so it'll do its own elutions, got its own elution circuit and zinc precip circuit, and it will be recovering its own gold and smelting its own gold. And there we've got ample capacity. It won't be limited only to the 1.3 million ton a month throughput. So if we were to add additional modules elsewhere, the carbon will come to DP2 and it will be treated there. And there's also space from some additional, if you want to put in additional reactor that brings a sort of a different level of agitation without destroying your carbon into the circuit, there's space for that as well. There's always a little bit, some bit of technology that you're looking at which you may want to bring in that can further increase your efficiencies.
Okay, so the NTP2 with the tailings storage facility will, I guess, also increase gold recovery through what? Higher throughputs, improved slurry handling. Are you chasing that?
So 1.2 million ton is the target, up from 500,000. So that per se, even on the same efficiency level, will give you higher output. But they're always, you're always looking at ways and means of improving extraction efficiency, and we've less space for that. The thing that will improve your efficiencies, even if it's just marginally at this stage, is finding a way to put more energy into your initial stages of absorption without destroying your carbon. And it does look as though there might be a solution for that, where you can stir more vigorously without breaking up your carbon. So if that opportunity presents itself, then we will definitely, there's space to roll that out as well.
Okay, so when you're in times like this, when people have money, they sometimes have visions of grandeur. So just for you guys, when you're sort of looking at the current plans, the guided plans, I said so you've guided the market previously about what you plan to do. Is this a time when you're looking at trade-off studies, when you're looking at opportunities in terms of securing, long-term tailings inventory, etc.? How are you looking elsewhere? And if so, are there kind of hurdle rates or gold price assumptions that you have to apply to even kind of go there?
Look, I'm saying to my colleagues, and I know this is tongue in cheek, that the only thing that you want to be doing in terms of deals now is you want to buy an exploration drill, because anything that hasn't, the cost of doing that hasn't gone up, but what you find has gone up in value. Or you want to be selling assets that you don't want anymore, that you know are going to be a problem when the tide turns. But you've got to decide what your value proposition is, and you cannot be anything but brutally honest about what your value proposition is. And we've decided that, and it's because of the nature of our assets and the capacity that we have and the potential that we believe we can still develop. Our value proposition is one of asset optimization. So we have a very large asset base. We can process at a particular rate. And our efforts are towards putting in the infrastructure to do that for as long as we possibly can and not leaving any value behind. Now, in addition to that, there's the possibility of a regional consolidation of sorts, which will add to the number of years that we're in business, if not the number of ounces that we produce. And we believe that our model is a very, very good model for responsible closure. And it could be profitable. It could be very, very profitable. Our company's been profitable since it started this journey. We haven't skipped a single year in the last 18 years paying a dividend. And some of those dividends were very, very small, but we haven't skipped a single year, and we've never borrowed money to pay a dividend. So we've been making real profit, cash profits now for the last 18 years. So it is a good model if you do it properly. So that's where we want to go. Now, we're not saying that, and by saying that this is our value proposition, what we're saying we are not. And there are other companies for whom this is the value proposition. They're saying that, we have a skill set. We know how to manage marginal assets. We have a sense of, where the cycle's going to go because we do our market research. So what we do is we acquire assets that are maybe second-tier or third-tier assets, not first-tier assets, but we sort of acquire those assets that are problem children in their current portfolios. And we develop synergies, and we bring in our efficiencies, et cetera, et cetera. And then when the cycle turns, then the market rewards us, then there's a huge reward. And then those are your quick reward companies. And they're very attractive because they're run by dynamic people that know their business. They're technically astute. They see opportunity where it is. They acquire these things and they do their magic. Problem is that those assets they are not, typically they're not primary assets. They're not tier 1 assets. They're tier 2 assets. So they do really well. They do exceptionally well when there's an upcycle. They sort of get by when you're in a normal cycle, a normalized cycle, and then they're in distress when the cycle turns weak. They lack embedded resilience. That's not our value proposition. Now, and we don't pretend to compete in that arena. Other companies compete in that arena. They have their following, they have their prophets, they have their apostles, they have their disciples, and they have their congregation. We're not in that space. We go to a different church. Our church is one of optimization. We have what we have. We look after it. We'll have embedded resilience, and we'll leverage what we've established. We'll see if we can bring about some sort of a consolidation, and then we want to take our message elsewhere and see if we can get some conversions done elsewhere in the world. So maybe the next guy, I've been doing this now for close to 20 years. Maybe the next guy or the next woman who gets to lead this fantastic team has a different view and can convince the board of a different strategy, and things will change. But this is where I believe we offer the best value.
Well, look, maybe that's a good place for us to finish with that kind of last question, because I don't need to talk to you about processing and metallurgy, or indeed the construction of the tailings storage facility, because you've demonstrated year after year, chasing these efficiencies is working for you. But if I look at DP2, if I look at the tailings storage facility, if I look at Fontaine, all kind of coming online, have you sort of guided market as to what were your expectations in terms of what that could do for you as a business in numerical terms?
Yes, we have. We are setting up infrastructure that should have the capacity to do 3 million tons of material per month. So that should be the throughput rate. That the design is tailored towards that. So we want to do 3 million tons a month, and we want to take production to around 200,000 ounces per year. And of course, what we believe should really be a very significant feature of this new model is that we will not be spending $110 million of growth capital every year. We'll be back to the 5% of cash operating costs as sustaining capex. So the more, depending on where the gold price is, the net cash flow margin should look a lot different then.
Now, good to catch up with you, and appreciate you kind of running through the kind of thought process, the mentality, and I guess the vision 2028 for the company. We look forward to seeing you again soon. Thank you.
Thank you, Matthew.